Friends, now we are playing TI motto song. I request all to put their right hand on their heart.
How do you share it? How do you share the screen?
Share screen है
हमें रिक्वेस्ट करो आगे कभी करेगा
Dear viewers, we are sorry that due to some technical problem, we are not able to connect with the faculty. But now we have connected, and I guess his video is not available. Webcam is not available, but within short time we will be able to establish that also. So now I request Chairman of Ahmedabad branch, CA Dhinal Shah, to give his open remarks on this fourth day. Thank you.
Thank you, Bishan Bhai. The speaker of the day is CA Dhinal Shah, the chairman of various other branches of Gujarat, the chairman of Direct Tax Committee, CA Sunil Sanghvi, and the secretary of branch, CA Bishan Shah, and members. I welcome you all to this last day of this international taxation series. I'm not going to make any kind of further announcements because we are already running short of time. But I can say that have a happy learning, and as you all know that we have very fruitfully ended up with this particular series, not just having webinars, but also preparing a summary, and soon we will be sharing the same. And just one small announcement, if you have missed out yesterday evening's webinar on investment, and today morning's webinar on having peace of mind from Nitin Parekh ji, really friends, both the webinars were truly worthful to listen. Soon we will share the link of the same. Kindly take the advantage of the same. With this brief words, I request Sunil ji to kindly directly introduce the faculty, sir, and start the session. Thank you.
Thank you, Dhinal Bhai. I welcome today's faculty speaker, CA Dhinal Shah, dignitaries on the dais, seniors and friends. Directly, I would like to introduce without wasting time further. See, CA Dhinal Shah is a partner of Ernst & Young Tax and Regulatory Service, Ahmedabad. He is a chartered accountant and also lawyer by qualification, and has more than 30 years of experience in advising clients on his field, that is the international taxation, cross-border investments, PEMA. Sir was also Central Council members previously for the 9 years and has participated in various committees of the ICAI. He was also a chairman of the Direct Tax Committee of GCCI. He has also addressed and presented various papers, seminars, conferences on this subject. With this brief note, I welcome sir and would request you to start the.
Thank you, Dhinal. Thank you, Bishan, and thank you, Sunil. And first of all, apologies on my behalf of some technology issue. We are getting delayed, and also I am not able to start my video. But in the interest of time, let's start. So first of all, I must appreciate the efforts of Chairman of the branch, Dhinal, the Secretary Bishan Shah, and the Chairman of the Direct and International Tax Committee to organize this webinar on international tax subjects. And today being the last subject, and I would believe that you would have enjoyed and learned something new in the earlier 3 lectures on the international tax. Today's subject is on the multilateral instruments, and I believe that you are able to see the slides on your screen. The let me give
Yes,
you
we
a
can see.
brief. Yeah, sure. So let me give you a background. What is the genesis of this multilateral instrument? The G20 countries 6 to 7 years back decided that the multinationals are shifting their base of taxation, and therefore the countries' base for collecting the taxes are getting eroded. And therefore that BEPS project, which was called Base Erosion and Profit Shifting, that was a genesis of the G20 country decision that how do we reduce this? And based on the economic activity performed in each of the country, each of the sovereign state should get their share of taxes. The G20 country came out with 15 action plans, and based on 15 action plan, there are certain action plan which were minimum standards, and there are certain action plans which are to be incorporated into law through the domestic law. For example, the first action plan on digital economy, the government is equalization levy in 2016, and in the last budget of 2020, the scope of equalization levy has been further expanded. There was an OECD Pillar 1 discussion paper where the entire business is now shifting from a physical presence to a digital presence. And there are practical challenges on implementing the digital presence way of doing a business, and how do you allocate the taxing rights between the jurisdictions. And therefore, the concept which is now changing, that from a physical presence, it is now changing to based on the market economy. And therefore, that is also under the discussion phase. And therefore, if you are aware that section 911 was amended 2 years back, which has been further extended by 1 year by introducing a concept called significant economic presence, SEP, which takes into account these market economy principles. So objective of the entire BEPS was coherence, substance, and transparency. There were the 3 pillars of the entire BEPS project. The other important amendment which was made under the domestic law by inserting section 94 capital B on interest limit deduction, where maximum 30% of the EBITDA amount of interest is allowed as a deduction. Similarly, action plan 13 on the country by country reporting from a transfer pricing perspective, that was also incorporated into section 286 of the Income Tax Act, and therefore that also have been part of the domestic law. The objective was that there are certain issues like action plan 2 on hybrid mismatch, action plan 6 on treaty abuse, action plan 7 on permanent establishment, action plan 14 on dispute resolution, where this needs to be incorporated into respective treaties. Now, there are almost more than 3,000 tax treaties across the world between different countries. And therefore, if each country decides to negotiate the treaty and then amend the treaty, it may not have been practically possible for every country to amend the treaty. Because if India and US was to negotiate a particular treaty, it would not only have covered these issues, but it would have covered other issues also. And then each country would have different methodology for the purpose of signing the tax treaty and ultimately implementing the tax treaty in a particular circumstances. For example, under Indian legislation, section 90 allows a delegated legislation to CBDT and a competent authority to sign the treaty. But countries like Australia, where you actually need a parliamentary approval for amending the tax treaty. And therefore, what Action Plan 15 decided that we will have what is called a multilateral instrument, or in the other word, a single document or a master agreement, which would cover certain principles of the tax treaty. And based on the mutual understanding of each of the countries have an option to adopt a particular clause of a particular MLI, and then that will be incorporated into an existing agreement. So in other words, the 1200 plus treaties to cover almost all the treaties across the world, which would get modified by incorporating the MLA clauses into a particular treaty. And that terminology was called a covered tax agreement, CTA. So let's take a simple example that today we have an India-Singapore tax treaty. India and Singapore has agreed that we will incorporate a treaty abuse related provision called principal purpose test into a tax treaty. And therefore, both have followed a process which we will understand later on, that this particular clause about the principal purpose test will be a part of the tax treaty, which is a part of an MLI. And once that MLI clause is incorporated into a tax treaty, that modified tax treaty is called covered tax agreement. So in other words, it's a master agreement for all the countries together, which the countries based on that respective country's decision will incorporate and implement the relevant clauses of the MLI into their tax treaties. The other important issue from an interpretation that it is not a protocol. So MLI does not function like a protocol. It has to be read along with the existing treaties. It only modifies the existing treaty. It does not replace the existing treaty. So for example, if the principal purpose test is already there into a tax treaty between the two countries, then there would not be any need to incorporate an MLI clause into the treaty. But if a particular clause or relating to principal purpose test is not part of the tax treaty, then both the countries would agree that we will incorporate this particular clause of an MLI into a particular tax treaty between the two countries. And therefore, protocol is nothing but amending a particular tax treaty or a supplementary and interpretation of a tax treaty, whereas MLI has to be read along with the existing tax treaty. There are two important concepts which is required to be understood, is what is called entry into force and entry into effect. Entry into force is the first day of the month following the expiry of the 3 calendar month on which the 5th signatory has deposited the instrument for ratification. So what are the steps? First is adoption of MLI. Second is signing. Third is ratification and notification. And then depositing the instrument of ratification with the OECD. So these are the steps which every country has to follow for the purpose of impact, for the purpose of giving effect to the MLI into a tax treaty. So what OECD, as a part of an Action Plan 15 document on MLI, that once the 5 countries of the world deposits the ratified copy of the MLI, that would be treated as an entry into force. So in other words, suppose if the 4 countries only would have ratified their copy of MLI, then the entire Action Plan 15 on MLI would not have come into force. But once the 5 countries have deposited, it comes into force from the 3 calendar months after the expiry of the last country which has deposited the ratified copy of the MLI. And for all other jurisdictions subsequent to the 5th jurisdiction, the first day of the month after the expiry of 3 months from the date of deposit of an instrument for ratification. The second terminology is entry into effect, and therefore entry into force is qua each country, and it is not qua each clause of a covered tax agreement. It is qua each country. The second terminology, which is into entry into effect. So for entry into effect, there are 2 separate dates for the purpose of entry into effect, one for the purpose of withholding of tax and one for the purpose of other taxes. So as far as for withholding of the tax is concerned, it is the first day of the next calendar year that begins on or after the relevant date. And for the other taxes, taxable period that begins on or after the 6th calendar month from the relevant date. Now, since India follows a financial year as a taxable period compared to many other countries which follows calendar year, India has adopted an option of replacing from a calendar year to a taxable period. So for India, everything will be governed by April to March, whereas for many other countries which follows calendar year, they would follow from April to December. So let's take one or two examples to understand this in more detail. I have taken two examples of Singapore and Canada. So India ratified and filed the notified document of MLI with OECD on 25th June 19, whereas Singapore deposited on 21st December 2018. Now entry into force is the first day of the month plus 3 months, and therefore for India, between India and Singapore, the later is India, and therefore 3 months from 25th June 2019 is 1st October 2019, July, August, and September, and therefore 1st October 2019. Whereas for Singapore, it is 3 months, which is 1st April 2019. Now, for the purpose, so entry into force is 1st October 19 for India and 1st April 19 for Singapore. Entry into effect is for India, since it has adopted a taxable period, it will be 1st April 2020, whereas for the Singapore, since entry into force is 1st April 19, it will be 1st January 2020. Vishan, there is some other screen is coming.
It is
Yes,
now
Dhinal bhai.
started. We are able to, we'll do that. We are fixing it. Just a moment, sir. Just a moment. I am making you again on this laptop. I am making you to share your screen.
Shall I continue?
Yes, sir. Yeah, you can start now.
So for entry into effect for withholding tax purpose, it is 1st April 20, and for Singapore, it is 1st January 20. As far as other taxes are concerned, it is also 1st April 20 and 1st January 21. The second example is Canada. So for Canada, India ratified on 25th June 19, whereas the Canada deposited on 21st December 19. And therefore, India, the 3 months is 1st October 19, and for Canada, it is 1st April 20. As far as withholding of tax is concerned, it will be 1st April 20.
You can directly start it.
Bishan,
sorry, sir. Sorry.
So for entry into effect for India purpose in respect of India and Canada tax treaty, it will be 1st April 20, which is 3 months after 1st October 19, starting from a taxable period. Whereas for the other taxes, it is 6 months, and therefore it will go back to 1st April 21. Whereas for Canada, both the dates 1st January 21 and the other taxes also, it will be 1st January 21. And therefore, one will have to understand the entry into force and entry into effect depending upon the ratification and documents filed with an OECD, and then to calculate 3 months and 6 months period depending upon the individual country. So this becomes very, very relevant. And why becomes relevant? That, so for example, for India and Singapore and India and Canada, when each one of us starts signing 15CB for the purpose of section 195, we will have to consider the amended clauses from the MLI, which is called cover text agreement. Now, what is the MLA content and the mechanics? So as I said earlier, the cover text agreement is a treaty modified under the MLI. And therefore, MLI applies to the cover text agreement to the specific provisions in the bilateral text treaties. There are certain minimum standards and there are certain optional provisions. And therefore, minimum standards are normally, it is expected that each of the countries should adopt unless each of the countries are able to demonstrate that they would negotiate bilaterally for the purpose of implementation of the minimum standards. But in a normal circumstances, it is expected that each one of them would consider the minimum standards.
Now we can see you, and I'm thinking.
We can see you, Dhinal bhai.
Yes. Yes, you are now unmute also. So Dhinal, kindly switch, put off that another laptop.
Yeah. Only 1 second. No? 1 second.
Go back to this. Mama, I get idea.
Hello. Hello.
मैं बोलूं છું
बंद करा. Okay. મારો ચેન્જ લુક બતાવો નતો પણ તે જોઈ લીધો. Sorry everybody. Sorry. So there are minimum standards and there are optional. Abhishan?
Sir, you have to share your screen. Share your screen, sir.
No, it's okay. I am reading from other laptop. Don't worry.
But sir, everybody will not be able to see it now. So kindly
Okay.
Share it from your laptop. From laptop only, sir. So we all have to evolve. That is what I can say. Technology and situation tell us to do.
Can you see the presentation now?
No, sir.
No. Yes, now we can see.
Okay.
Now it's perfect.
एक effect. Change कर दे. Okay. So I was talking on minimum standards and the optional standards. Then there is an agreed BEPS measure that you spelled out the provisions which are likely to be incorporated into cover text agreements. And the next important issue is on the compatibility clauses, which we will look at 1 minute down. Then there are reservations. What is reservation? Reservation is basically a power given to each country that a particular clause under an MLI, he would not like to opt in. So for example, today, as far as dependent permanent establishment is concerned, though India and Singapore have ratified the document and have agreed to amend the treaty by an MLI, but as far as Singapore is concerned, Singapore has filed a reservation about incorporating a particular clause about dependent permanent establishment. And therefore, that is a power given to each of the jurisdiction that they have a right to to have your reservations about a particular clause. And then the notifications that once you have chosen the options and reservation, then you notify to the OECD by way of the notification that which clauses the country has decided to opt in or to opt out. What is compatibility clauses, and this is the most important for the purpose of understanding about the incorporating an MLI into a treaty to make it a covered tax agreement. So the first terminology is applies in place of an existing provision. So in other words, only when there is an existing provision in the covered tax agreement, then only this compatibility clause will apply. In other words, the MLI provision replaces the existing CTA provision. If there is no such similar provision existing in the treaty, then this will not have any impact whatsoever of the MLI on the covered tax agreement. And therefore, all treaty partners have to notify the existing CTA provisions. So this is in place of. The second compatibility clause is applies to or modifies an existing provision. So in other words, if there is an existing provision, then it changes the application of an existing provision without replacing it. So what would be the application of a particular provision? That would be driven by a compatibility clause of modifies or applies to an existing provision. If there is no similar provision in the tax treaty, and again, it will not have any impact. The third category is applies in the absence of. So in other words, if there is no particular provision in a tax treaty, and if the countries decide to incorporate a particular MLI provision in the CTA, then this compatibility clause will be applicable. And again, all treaty partners will have to notify the absence of provisions in the CTA. And the fourth, which is most important, is applies in place of or in the absence of. In this compatibility clause, whether existing provision is present in the CTA or absent, this clause will apply in any situation. Applicable only when the contracting jurisdiction has not made any reservation on application of these provisions. In other words, it will replace or supersedes the existing provision or is added to the CTA in the absence of existing provision. So it is applicable in both the situation. It either replaces or is inserted because it is in place of or in the absence of. And therefore, this will become a very relevant from the compatibility clause perspective. And each of the article under MLI has have a compatibility clause which would be driven for the purpose of understanding that whether a particular clause of MLI would be incorporated into CT or not. So let me give you a chart So for example, you have a country A and country B. You have a compatibility clause of in place, and it is notified for opt-in and opt-in. Then it will be yes and no. If it is a reserved item, then again it is no. If it is silent, then again it is no. If it is reserved opt-out or a silent, also it will be no. In other words, unless both the countries have opt-in for a particular clause, then only it will be applicable. Otherwise, for all other situations, it will be no. Similarly, for applies in or modifies, the same principle that both the countries have to opt in and opt as a principle of MLI. Otherwise, if one is opt in and other is opt out, or somebody has a reservation or somebody is silent, then also it will be a no situation. In the absence of the same principles that both the countries have to opt in for that particular clause, otherwise for every other situation, it will be a no. In the fourth situation, in place of or in absence of, if both the countries have opt in, then it will be yes. But in addition to both the countries opt in, if one of the country has opted in, but the other country is silent, then also it will be applicable. Or if both the countries are silent, then also it will become applicable. But on this principle, there is two exceptions. Exception on Article 5 on elimination of double taxation and Article 8 on dividend transfer transactions. Because there are certain additional conditions which are attached, and therefore only by mere silent on a particular clause in this compatibility situation, it will not automatically apply, and therefore both the countries will have to opt in as far as Article 5 and Article 8 is concerned. So let me give you a summary of how does it work. So the first step is, has India notified a treaty with country A as a cover tax agreement? If answer is no, then there is no change in the existing treaty. If answer is yes, then the second issue is, has country A has notified the treaty as cover tax agreement? Again, if the answer is no, you go out. If answer is yes, then you check the substantive provisions adopted by India, which is country A. Then, as we discussed earlier about a minimum standards and an optional standards, if it is a minimum standards, check the compatibility reservation and notification made by India and country A. If yes, then the existing treaty between India and the country A will stand modified to the extent of MLI. In respect of optional standards, the same principles, except that if it is incompatible or there is a mismatch, then it will not apply. Otherwise, it will again modify the existing standards. So one will have to follow these steps for the purpose of incorporating a particular MLI clauses into a CTA, so that one is able to apply to while interpreting a tax treaty as modified by the MLI. On 1st April 2020, these 29 countries have been impacted between India and these 29 countries. So for example, all these 29 countries treaties have been impacted because of the MLI from effect from 1st April 20. And therefore, whenever you remit the amount to these 29 countries, you will have to examine the treaties as modified by MLI, and then you will have to remit the money under section 195, which also we will discuss in next few minutes. Interestingly, US, Mauritius and Germany have not been part of a MLI process, and they have not been a part of this discussion, and therefore tax treaties with US, Mauritius and Germany have not been modified as of now. There is a terminology called synthesis test, which we will look at slightly later. This is a screenshot of an OECD MLI matching database. So OECD, since it is a depository for all the ratified CTA, the OECD has created this matching database, so you can actually put both the countries' name, like an example on your screen, it is India and Singapore, and then what is the signature of an MLI, what is the ratification, and what is the date of ratification and status list. And then you will have understanding that which clauses are there for the purpose of part of the CTA, and which clauses you will have certain reservations for the purpose of implementing that particular agreement. And therefore, one can go back to this OECD MLI matching database whenever one is evaluating the implications of MLI on the CTA. We are all aware that section 195, which requires to deduct TDS on any sum chargeable to tax when any payment is made to a non-resident. So it starts with that any payment made to a non-resident in respect of income chargeable to tax, one has to do a TDS at an applicable rates. Section 90 allows to take the treaty benefits, and therefore any between the treaty and the domestic tax, whichever is beneficial, one can follow that particular route subject to certain compliances like TRC and Form 10F. Now, earlier we saw that once entry into force, there are different dates for implementing the withholding tax and for implementing the other taxes. Like for example, what we saw that for India and Canada, for withholding tax purpose, it is 1st April 20, but for other taxes, it is 1st April 21. Now the question is that how do you apply withholding tax provisions vis-a-vis the other taxes? Let's take a simple example. If today any Indian party has to remit a royalty amount to the Canadian company, since the India-Canada treaty has been amended by an MLI, one will have to examine that is there any changes as far as India-Canada treaty is concerned. One of the clause which is a principal purpose test, which has been incorporated as Article 6 on a treaty abuse, and therefore that would be a part of the India-Canada treaty. Now, whether do you need to implement from 1st April 20, or ultimately the taxes are payable by the recipient when a particular liability is crystallized by the recipient, and therefore it should be applicable only from 1st April 21. Now today there are two views are possible, and there is no clarity or confirmation from any of the regulators, and therefore at some point of time the regulators will have to clarify this position. But if I go back to the Shom Committee report, which was issued by the Shom Committee on GAR provisions, so one of the para which was incorporated into a Shom Committee recommendation, that when you do a withholding of or tax on royalties, fees for technical services, or a dividend which is normally treated as a passive income, which is based on a source-based taxation. Since the source of royalty, source of technical fees, or source of dividend is India, there is an obligation under section 195. And therefore, one have to deduct TDS after 1st April 20 based on the amended treaty between India and Canada or any other country. But hypothetically, if there is a permanent establishment of a Canadian entity in India, the liability of the permanent establishment will be determined as a business income, which is not applicable from 1st April 20, but it is applicable from 1st April 21. Now, can somebody argue that the withholding tax provisions are also deferred to the date which is applicable from applicability of entry into force of other taxes? Now, that is a question for debate, and that is a question for clarification to be issued by the government. But I would believe that in the absence of any clarity, because if you fail to deduct any TDS, then the tax department can treat you as a representative SSE under section 163. And therefore, instead of having any liability after remitting the amount, because if you do not remit, do not deduct the TDS, and if tomorrow there is a notice from the department under section 201, then you would be obliged to pay this amount, and you may or may not get a refund from the payee. And therefore, I would believe that on a conservative basis, one should start deducting the TDS as amended by the MLI after taking certain precautions, which I will take you to 2 or 3 important precautions later on. So this is one open issue for discussion, that whether the entry into effect of the withholding tax and for other taxes, whether the withholding tax date also is deferred to the other taxes date, or one should start complying the law of withholding tax from 1st April 2020. Let me skip this slide. We have already discussed about this, and therefore I'll skip these and these slides. I'm sorry. What is synthesized text of the cover tax agreement? As we saw earlier, there are minimum standards, there are optional standards. There are reservations which could be opt out by many countries on particular clause, what we discuss about India and Singapore. And therefore, every time when you read the treaty, it becomes very, very cumbersome and difficult to read the treaty and to find out that from which date this particular clause will become applicable. And therefore, there are likely chances of mistakes or omission by a taxpayer. So to avoid that, OECD allowed that many countries can have a synthesized text. So synthesized text is nothing but the cover tax agreement which incorporates the MLI provisions. So for example, if a principal purpose test was not there in the tax treaty, but is now incorporated into India-Singapore Treaty by virtue of MLI, that clause will found place in a synthesized text so that it is easy for the reader of the treaty to understand that which clauses of the MLI have been incorporated into a tax treaty. So it is nothing but the revised tax treaty as incorporated by the MLI provision, so that it becomes reasonably easy for everybody. The only practical challenge, and with the OECD and the countries have agreed, that synthesized text could be either each individual country can decide. So for example, India can say that we will issue a synthesized text, but we will not consult the other country. For example, India and Japan, or India and UAE both agreed to share the synthesized text after deliberating and after removing any inconsistency between the two, so that there is no inconsistency on interpretation between the two. So India and UAE has issued the synthesized text after discussion mutually by both the parties, whereas India and Japan issued the synthesized text without consulting each other. The OECD has clarified that synthesized text is only for the purpose of more user-friendly understanding of the tax treaty, but it is not a legal document. In other words, if there is inconsistency in any of the synthesized text issued by the government, the final interpretation will be the document which has been negotiated and ratified, or ratified by each country, and which has been submitted to the OECD. So if there is inconsistency between synthesized text and the ratified document will prevail over the synthesized text, and therefore to that an extent the synthesized text may not be relevant for the purpose of interpretation of a particular amended CTA. And in next 2 slides, there are some inconsistency on the synthesized text between India and Japan. So this was just to give you a perspective that there could be some non-uniformity between the two countries, and therefore ultimately one will have to go by the ratified document which has been filed with OECD. Again, I'm skipping these 2 slides, and one can read these at a relevant point of time. Article 6 of the CTA, which is nothing but a treaty abuse. What is treaty abuse? Which is similar to our GAR provisions. Section 95, which is effective from assessment year 17. Which is effective from 1st April 2017. That if there is a main purpose of any arrangement or a transaction, then it could be subject to our GAR provisions, which has been explained in section 95 to 102. In case of a treaty abuse, the concern of the sovereign states was that there are many investors who invest through a particular country only for the purpose of taking the treaty benefit without any substance, which loosely we call a treaty shopping. Now, what the preamble is that intending to eliminate a double taxation with respect to taxes covered by this agreement without creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including treaty shopping arrangement, aid at obtaining relief provided in this agreement for the indirect benefit of the residents of third jurisdiction. The simple example which many times we discuss, that many US companies have invested in India via Mauritius. Is there an objective of investing through Mauritius, or it was only for the purpose of taking a treaty benefits or a treaty shopping, and the objective was not a commercial objective? So all the treaties where India has adopted the MLA, and India is silent as far as this Article 6 of the MLA is concerned, being a minimum standard, and this title and preamble will be incorporated in all the preamble of the treaty which India has. If you go back to a Supreme Court judgment of Azadi Bachao Andolan, where a circular 789 was changed, that the preamble is relevant for the purpose of understanding the intent and object of the tax treaty. And therefore, after the amended CTA, based on this preamble, one will have to understand the intent and objective of the tax treaty, that whether the object of the tax treaty is not to allow treaty shopping, or the object of the treaty is not to allow tax evasion. And therefore, one will have to take care about interpreting the tax treaty after incorporating the preamble into a tax treaty. The other article which is important is Article 7, which is prevention of a treaty abuse. What is PPT rule? I just read few lines so that you understand this perspective. Notwithstanding the provisions of the cover tax agreement, a benefit under a CTA shall not be granted in respect of an item of income or capital if it is reasonable to conclude, having regard to the relevant facts and circumstances, that obtaining the benefit was one of the principal purpose of an arrangement or a transaction that resulted directly or indirectly in that benefit, unless it is established that granting that benefit in these circumstances would be in accordance with the object and purpose of the relevant provision. So in other words, whether obtaining the benefit was one of the principal purpose of an arrangement. Let me take us 2 slides down to understand a GAR versus PPT. If you read the GAR provisions under the domestic tax, it uses the word main purpose is a tax benefit, and one of the tainted element test is present, whereas MLI is one of the principal purpose. Now, does it mean that to the extent of the language use main purpose versus one of the principal purpose, the domestic GAR has a more stricter objective of main purpose, whereas MLI is a slightly on a lower threshold as far as one of the principal purpose. And there could be debate on both the sides. I'm not going into that as of now, but otherwise these two terminologies becomes very relevant as far as one of the principal purpose versus main purpose, which is a GAR provisions. Now, the MLI has to opt for any of the 3 alternatives. It is only principal purpose test or principal purpose test plus limitation of benefit rule, which is LOB. In LOB also there are detailed LOB versus simplified LOB. And then you have a detailed LOB plus mutually negotiated ND conduit rules. Depending upon the countries and depending upon the negotiation between the parties, the countries have adopted either only PPT or PPT plus LOB, and that LOB could be either a detailed or a simplified, depending upon the India's position. So what India has done, that India has expressed its intention to adopt the PPT as an interim measure with an option to modify in future with an LOB clause. That is what the India's position as far as this. If I put it simply, that whenever any investments are made from any particular country, whether the object was to take a treaty benefit or the treaty itself has an intent and object for the purpose of taking a particular benefit. So for example, if a particular treaty has an intent and object to promote investments and cross-border investments, and if those conditions are fulfilled in intent and object, then to that an extent PPT's taste is not fulfilled. But if the intent and object was not to promote cross-border investments, or intent and object is to avoid treaty shopping, intent and object was to avoid tax evasion, in that case, the principal purpose test becomes very, very relevant, and one will have to fulfill the substance test from a PPT perspective and to demonstrate that one of the principal object of an arrangement was not to take a treaty benefit, but it was more of a commercial reason. In other words, in a simple terms, either you take a principal purpose test or a GAR, ultimately one will have to demonstrate a substance of any transaction and commercial rationale for investment to a particular country rather than only taking a treaty benefits of a particular country. Again, in the interest of time, since anyway we are delayed, I will skip this. This is nothing but that how do you establish a PPT test, and therefore for steps for the purpose of whether are you fulfilling the principal purpose test or not, these are the steps. These are the examples which are given by the OECD, that how do you apply the principal purpose test limitation. If I just take one example, the first example, that T owns the shares of S company. In the absence of the T and S treaty, dividend by S will be subject to 25%. But before the dividend is declared, the T company assigns those rights to the other country where there is no withholding of tax. This is actually violating the principal purpose test, and therefore it is not satisfied, and therefore even the object and purpose test is not satisfied, and therefore one would not be entitled for a treaty benefit with a nil withholding tax on a dividend. So these are few examples based on the OECD discussion paper, and you can go through at a later point of time. This we have already done. Only to take 1 or 2 minutes on simplified limitation of benefit. Simplified limitation of benefit is also grants a benefit to a resident of a contracting jurisdiction on satisfaction of any of the following conditions. So resident should be either a qualified person, resident should be carrying on an active trade or active business in a country of residence, or there are derivative benefit rules. Again, the simplified LOB clause has to read either independently or along with a PPT, and therefore one will have to comply those conditions once you are going through the cover tax agreement. Let me take 1 or 2 case studies. The first case study was an interpretation and object and purpose of and grandfathering of the PPT and interpret between the GAR and the PPT. So the simple example is that there is an US company which has invested into Singapore company, and Singapore company in turn has invested into Indian company. Singapore company has partially funded Indian company by way of an equity and partially funded by way of a debt. Now we are all aware that when the India-Singapore tax treaty was amended, there was a grandfathering that any investments made prior to 31st March 2017 were grandfathered, and therefore India would not have a right to tax capital gain when the shares are sold. Similarly, in case of a GAR provisions also, any investments made prior to 1st April 17 has been grandfathered, and therefore that also would not be subject to a GAR test. The question is that do you also get a grandfathering from a PPT analysis? The answer could be yes or answer could be no. and therefore one will have to examine on the different situations. So in a first situation, when the Indian company's investment is prior to April 17 and a sale is also prior to April 20, the both GAR and PPT does not apply because PPT becomes applicable only from 1st April 21. I'm sorry, 1st April 20. If the ICO company shares were acquired prior to April 7 but are sold in 2021, the PPT test would need to be complied with because it is now a part of the treaty. The question is that whether a PPT applied to GAR grandfathered investments or GAR overrides the PPT. That's a question for discussion. And then the CCDs which has been invested prior post April 17 and also sold in 21, and therefore the GAR and the PPT both tests would need to apply simultaneously. I would believe that the principles of GAR and the PPT would normally be same, and therefore if one of the principles are complied, the second principle normally should be reasonably complied with. On the second situation, there could be more than one view. View one could be that since the PPT has been incorporated into MLI after 1st April 20, the PPT test will need to be complied with. The second view, that since the investments have already been grandfathered prior to April 17, and therefore the PPT test which has been incorporated subsequently, even when the MLI was under discussion between India and Singapore for the purpose of PPT test, both the countries are aware that this clause is applicable and this grandfathering was already there of the investment made prior to April 17, and therefore the PPT test should not apply. And the third view, that this particular exemption is under Article 13 on a capital gain, where there is already certain limitation of benefit conditions, that one need to have certain expenditure, one need to hold certain investment. And since there is a specific LOB clause and for a particular clause which has been grandfathered prior to April 17, the other reasonable view or a balanced view would be that since when the treaty was, the MLI was negotiated between the countries, and since both the countries are aware that there is already a LOB clause under Article 13, to that an extent, if Article 13 principles are fulfilled, then the PPTCs is not required to be fulfilled. So there could be more than one view, and one would have to interpret these at a relevant point of time. But these are the challenges which will raise in future when one is trying to examine the India-Singapore tax treaty. On a agency P rules, Article 12, you are aware that Section 911 was amended 2 years back, where under the dependent permanent establishment or dependent business connection, the earlier language was that whether a non-resident has given an authority to conclude contracts to a resident. Now, the language is that whether the Indian party plays a principal role in concluding the contract. So therefore, earlier it was only concluding the contract. Now it is principal role played in concluding the contract. If you see on your slide, the wider scope of the agency P, so under MLI, it says who habitually plays a principal role leading to conclusion of contracts. And in this, it is beyond the domestic tax that are routinely concluded without any material changes. So that are routinely concluded without any material changes is not a part of the domestic tax, that is a part of a tax treaty. And therefore, if I just take a simple example, that if an Indian party is a commission agent and is an agent of a foreign party selling the goods on behalf of the foreign party, in those cases, earlier the situation was, before even amending the domestic tax, that if the agreement is finally signed by the foreign party and the Indian party does not have an authority to conclude contract, in those cases one would be saved from a dependent PE exposure. After the amendment, even if the Indian party plays a principal role in concluding the contract, though he may not actually conclude the contract, but he is playing that principal role, then also it could trigger a dependent permanent establishment. And therefore, all your clients which are having a commission agent arrangement between a foreign party and an Indian party, you'll have to examine these from a treaty perspective. You'll have to examine these from an MLI perspective. There are many countries which have already incorporated this amended agency PE rule under the cover tax agreement. And therefore, all those agreements one will have to examine that does it fall into this trigger or principal role in concluding the contract, or that are routinely concluded without any material changes. So I think the factual exercise one should do that, so that one is not wrongly fall into MLA provisions, and therefore there is an implications of a permanent establishment in India. This is what I discuss. Let me also take 5 minutes on anti-fragmentation rule. What is anti-fragmentation rule? That you are carrying out a preparatory auxiliary activity. You are also carrying out certain other activities. But by artificially dividing the activities between the two, you are trying to avoid a PE taxation. What Article 13 provides that if you are rendering a preparatory and auxiliary services as a non-resident in India, and you are also rendering through a group entity some other activities, in those cases, or if there are two separate contracts for preparatory and auxiliary activities and the other economic activities, both would be treated as one activity. So one would not be artificially fragment the activities to avoid a PE exposure. Recently, the Supreme Court in UAE Exchange has confirmed the decision of the Delhi High Court to say that if the preparatory and auxiliary activities are there, then you do not create a permanent establishment. The Article 13 of MLI's objective is that by artificially fragmenting the activities, one should not avoid a permanent establishment exposure. And therefore, one should be very careful in signing an agreement or fragmenting an activities between different agreements, so that one should not fall into these clutches of an Article 13 of the MLI. Anti-splitting of contracts, which is Article 14. You are aware that under existing Article 5, particularly when you are doing an installation or a construction activities, there are always certain thresholds under the agreement. So if you carry out activity in India up to 90 days or up to 180 days or up to 270 days, then you do not create permanent establishment. Now, sometimes the agreements are for 300 days, but the particular treaty provides 180 days, and therefore you fragment or split the contracts between the two of 150 days each, so as to avoid a permanent establishment, either between the related parties or by bifurcating the activities. So again, the Article 14 takes play of anti-splitting of a contract, that if the project is one, if the activities are one, what is in substance the contract, and if in substance the contract is one which is likely to continue for 300 days, then you can't artificially split the contract to avoid a permanent establishment exposure. And therefore, whenever there is a analysis of a construction permanent establishment, you must consider entire activity as a whole, rather than splitting the contracts into different parts or between different entities. And therefore, one should take their care. Payment of dividend. From a payment of dividend perspective, domestic tax has amended the dividend tax provisions from 1st April 20. And therefore, if today any Indian company has to declare a dividend to a foreign shareholder, it will have to deduct the TDS under section 195 at 20%. But if the treaty provides a lower rate, then one would be able to have a lower rate of TDS. The example before you is a country with Slovenia. So if there is a country from Slovenia is invested into Indian company, and if India has to declare a dividend today in the month of April 2020, then the question is that what would be the appropriate withholding tax? Now, normally, every treaty would provide that for the purpose of taking a benefit of a reduced rate of withholding tax, the foreign party should hold minimum 10% or 25% shares of an Indian company. In this case, the Slovenian company is holding 6% and 7% respectively since April 2016. But the treaty provides that I should hold minimum 10% for the purpose of taking a treaty benefit at a lower rate of 5%. The question is, the question is that can I take the benefit of a reduced rate of 5%? In this case, the Article 8 of the MLI that provides now that the foreign investor or a foreign entity must be holding these shares for minimum last 365 days. The language used in Article 8 is throughout the 12 months period. Now, one question arises is that throughout means only the prior 365 days, or it also includes post declaration of a dividend. So today, if the dividend is declared on 3rd May 2020, does this mean that the foreign investor should continue to hold the shares even subsequently till 2nd May of 2021? So there is an interpretation issue on what is meant by throughout 365 days. And therefore, if the foreign investor holds shares for minimum 365 days, then only one would be able to take a treaty benefits. And then one should be able to take a reduced rate of withholding tax on this. The exception is only that if there is a reorganization through a merger or some other corporate reorganization process, then this there is a relaxation on this clause. But otherwise, one should be able to meet that condition of 365 days. The question is that if both the entities were holding 6 and 7%, and if one entity transfers immediately before the dividend 6% shares to the other entity, would this 365 days condition would be fulfilled? If the objective was to only take a treaty benefit of 5%, again, one is failing on a principal purpose test, and therefore one would not be able to take the benefit of a treaty of lower withholding tax of 5%. This is a summary of the key articles. I will only take 1 or 2 articles which are important. One is on the Article 4 on dual residency. So what Article 4 provides, that if there is a dispute about that which country is a taxpayer is a resident of which country, there is a dual residency. So if the company is incorporated in country X, but the place of effective management is in country Y, and if the India has to remit a payment, which country has to be considered? In those cases, the countries have adopted for the same MLI provisions, and therefore Article 4.3 of the CTA will be replaced by the MLI article. The article provides that for any tiebreaker rule, it will be decided by 2 competent authorities through a mutual agreement procedure. The question would arise that today, if you have to remit the money, you do not know that which country he is a resident, and therefore, and the mutual agreement procedure would take some months and years. How will you decide the treaty, the particular withholding tax rate? And therefore, this would be a practical challenges on implementation of the MLI provisions as far as dual residency is concerned. The preamble, treaty abuse and dividend taxation, we have already brought agencies, specific activities, splitting also we have seen. Article 17 is on corresponding adjustment. We are aware that today, under the transfer pricing provisions, suppose if the Indian tax office makes an adjustment, say for example, I have purchased goods for 100 rupees, and the Indian tax officer says that no, you should have purchased only at 95. The arm's length price is 95. What happens to that 5 rupees? India company has to pay tax, but there is no corresponding adjustment in the US that his selling price was 100. That will not be reduced to 95. In that means on $5, there is a double taxation. Both India levies the tax and the US also levies the tax. So on a corresponding adjustment, there is an amendment in Article 9.2 of the Model Convention of the OECD. And India has reserved the right to apply this article that already contain enabling provision. So India has a reservation, and unless the India releases the reservation or agrees to modify this to that point of time, this article will not be incorporated into the treaty. And as far as arbitration is concerned, India has agreed not to follow this, and India has opted out from the arbitration clause as far as Article 26 of the MLA is concerned. I think we could cover majority of the provisions, and in the interest of time, I leave it to Sunil for certain question answer if there are members, or we can extend for a few minutes. I'm fine. Thank you.
We can extend if you want 5-10 minutes. We can extend Dhinal if it is required.
I'm fine. I'm fine. Depending upon the members, because it is Sunday afternoon, having a ras and puri, so I leave it to the members.
But all the days are right.
The members 125 members now. So if it is covered in your slides, then or a case study if you want to cover, you can.
Okay. So, Bishwan, my suggestion is that if anybody has a question first, maybe, and then we can go back to the question.
Okay.
Yes, sir. So there are two questions, and Sudhir bhai, if you can ask the first one.
Yeah, I'm asking. Dhinal, whether this MLI will supersede the double tax treaty, or what will be the stand of double tax treaty after this MLI, if it is there?
So MLI does not supersede the tax treaty. You have to read MLI along with the tax treaty. So
Okay.
tax treaty remains as it is. The MLI clauses will be incorporated into existing tax treaties, and you have to read along with the tax treaty. And therefore, when I used earlier what is called synthesized text, that synthesized text is basically for more user-friendly understanding of a treaty, that those particular MLA clauses are inserted into a tax treaty so that you read a particular clause along with that. So for example, when we discuss about the dividend taxation of 365 days, so that condition will be incorporated into a tax treaty so that whenever you read a treaty, you have to also meet condition of 365 days.
Okay, thank you, Dhinal. The next question is,
Second question is, what document shall we ask from clients while providing 15 CB to comply with PPT test, dual residency, and any changes?
So I think I must appreciate I should have covered this. So today, what happens that whenever there is a withholding tax obligation and when a chartered accountant certifies 15 CB, we normally take a declaration from a non-resident that he does not have a permanent establishment. In addition to that, we also take tax residency certificate if he does not have a PAN, or if I want to take the benefit of a tax treaty. Now, ideally, today what happens in majority of the countries, including India, when you take a tax residency certificate, it is a standard format that are you paying taxes in India? Are you paying taxes in a particular country? What is your activity? What is your incorporation? And the respective government do not examine the PPT test or any other conditions of a tax treaty. And therefore, I would believe that along with the TRC, one should take a declaration in the same declaration of a non-P that they comply with a principal purpose test and that they are the beneficial owner as far as the royalties, FTS or dividend taxation is concerned. So I think the declaration which every one of us are taking from the respective recipient of those remittances, those declarations should be modified. It should now include no permanent establishment. It should include that it is complying with a principal purpose test, and also they are the beneficial owner of the remittance, so that at least from a payer perspective, we have reasonably complied with section 195.
thank you, Dhinal. See, one question is how to define withholding taxes and other taxes.
So there is no definition of withholding tax or other taxes. But if you read certain OECD commentary or certain foreign authors, withholding tax is nothing but a tax which is paid upfront while remitting the amount. and therefore what we call under domestic law called tax deducted at source. Though in many countries, the withholding taxes could be a final tax also. But normally in many countries, or I would put it majority of the countries, the withholding tax is an tax which is deducted while remitting the amount. The other taxes would include like capital gain tax or any other taxes which are not akin to a withholding tax. So for example, in a royalties on FTS or a dividend, the rate of taxation are normally given in the tax treaty. So you would say that under India-Singapore treaty, the TDS rate on royalties or FTS is 10%, or for a dividend it is 15%, or for an interest it is 10%. Whereas for business income or whereas for capital gain, it is normally driven by the domestic tax rates. And therefore, those taxes would be treated as another taxes, whether normally the passive income would be treated as a withholding taxes.
Yes, Bishan bhai.
Next is, will it be okay if the SSE rely on the declaration undertaking received from the foreign party for the purpose of TDS under section 195? Is it enough to protect the SSE from invoking of 163 in case the declaration is wrong?
So I would believe that it is not possible for an Indian party or an Indian chartered accountant to go back and verify each and every factual aspects of the recipient of that. But the declaration which is given by the payee should be reasonable, should be bona fide, and I would believe that whenever you get a declaration from a recipient, you should also do independent check from the Google or any other public information. So for example, many times there is a declaration that we don't have a permanent establishment in India. But when you actually go to Google, the foreign party has a branch office in India. Foreign party has a dependent agent in India. And therefore that raises certain questions that I have a declaration which is no P, but you already have an agent, you already have a branch office in India. And therefore that creates a further inquiry. But otherwise, under normal circumstances, a declaration which is given in a bona fide manner would be a reasonable obligation from a chartered accountant perspective.
Thank you, Dhinal. The next is, if the foreign company have two contracts of construction, none of the same exceeds a period of 183 days each as provided in article of tax treaty. Therefore, the SS is outside the definition of P. Will after MLI it will be club?
So there is no intention to club all the agreements. The intention is that when a taxpayer was artificially splitting the contracts. So as I said, suppose I am in the process of construction of a machinery in India, and I believe that approximately it will take 140 days. Now the treaty provides that if the installation period is less than 90 days, you will not create a permanent establishment. So what I will do, I will have agreement 1 which is for 75 days, and then I have a related party agreement for another 65 days. So if I artificially split the contracts, then you fall into an MLI clutches. But if there are two independent contracts not connected to each other, and if both the contracts are less than 75 or 90 days, then one would not be subject to a permanent establishment. So the existing principles of independent contracts and not connected activity does not change. It is only in those cases where you are artificially trying to split the contract to avoid a permanent establishment.
Okay, thank you.
Next question, Dhinal bhai, is from Hiret bhai. Would declaration about PPT compliance serve the purpose since the payee comes through layer or may be reluctant to confirm to payer or issue of confirmation?
This question will be the last question.
So I would believe that if it is a related parties, then one would be able to understand the layers and the substance. Suppose if there is a related party transaction, the US company has invested into Netherlands company has invested into Singapore, and Singapore has invested into India. One would be able to seek more information from a related parties and then examine the principal purpose test of each of the entity. But suppose if it is not a related entity, or the other party is not willing to disclose their confidential information about structure, substance, activity, revenue, in those cases, it would be extremely difficult from a payer perspective that how will you examine the PPT test of a recipient. In those cases, I would believe that the bona fide declaration plus reasonable due diligence would be a sufficient from a payer perspective, because something which is not possible for a payer to examine cannot be fastened on a taxpayer. But I would believe that this is a challenging time, and I think the time will only say that what would be the obligation from a taxpayer. I would only request all of you that whenever you sign a certificate, take a bona fide declaration, make some reasonable due diligence, and then only issue a certificate, so that at least in future you are not subject to any further complications or issues from a tax department.
Thank you, Dhinal bhai. Yes, Bishan bhai, let's complete.
So, Dhinal bhai, now we are concluding this webinar here. But before that, sir, you are a leader who knows the way, who goes the way, and who shows the way. Thank you very much for deliberating and sharing knowledge with all the members of the branch and participants. Friends, since it's a last day, but it doesn't mean that our learning will end. So if required, Dhinal bhai is there for all of us to make us learn and clear our doubts. So do write to branch email ID, where we will try to compile all those questions and send it to the members. So once again, thanks all the participants, the International Tax Committee Chairman CA Sunil Bhai Sanghvi for arranging such a wonderful series, and Dhinal bhai, we can say that under your leadership and motivation it happened. Thank you very much, sir. Namaste. Stay home, stay safe. Thank you.
Thank you. Thank you. Thank you.